The worst appears behind the Alberta economy, but growth will remain subdued in 2017 as the fallout from lower oil prices lingers. Real GDP is expected to grow 2% after 2 years of contraction that arguably marked the toughest economic conditions since at least the mid-1980s. The energy sector directly accounts for roughly a quarter of Alberta GDP, 6% of employment, and almost 2/3 of private non-housing capital spending. As a result, the drop in oil prices and deep capital spending retrenchment cut heavily from provincial growth, but that appears to be at last stabilizing. Last year's wildfires also temporarily cut oil production by more than 1 million barrels per day, so output this year will get a boost as that production returns to normal. Looking a few years down the road, the current investment downturn will likely lead to a flatter production profile, and barring a significant supply shock, we don't believe oil prices will return to levels that will spur another investment boom. The housing market is in the midst of a deep correction, with benchmark prices in Calgary down 6% from peak levels, though that market balance has stabilized. Commercial vacancy rates have also surged, topping 25% in Calgary's downtown office segment, and cap rates are rising alongside a glut of supply and weaker demand prospects. The fallout in that sector will likely run longer and deeper. The labor market has weakened considerably as well, with the unemployment rate jumping above 8% for the first time since the early 1990s, though recent signs show job losses are finally stabilizing. Notably, the province's jobless rate has topped the national average for the first time in 27 years. However, we do believe that with oil prices likely to average about $55 a barrel this year, there is finally some light ahead for the Alberta economy.